Good evening. As the sun sets over the city and the lights of the financial district flicker on, the mood in the markets is anything but calm. Tonight, we find ourselves at a crossroads, with investors and analysts alike searching for direction amid a swirl of uncertainty. Today, September 3rd, 2025, the financial markets are sending mixed signals, reflecting investor uncertainty. On trading floors and in home offices, eyes are glued to screens as the numbers shift, and the headlines keep coming. The mood is tense, with every tick of the market watched closely for clues about what might come next. Dow Jones futures are down, hinting at trouble for industrial giants and raising concerns about the broader health of the economy. The decline suggests that traditional sectors, manufacturing, energy, and transportation, are facing headwinds, perhaps from slowing demand or global uncertainty. Meanwhile, the Nasdaq futures are up, showing optimism in tech. Investors seem to believe that innovation and digital transformation will continue to drive growth, even as other sectors struggle. The tech-heavy index is buoyed by strong earnings reports and the promise of new breakthroughs. The S&P 500 is barely moving, caught between these opposing forces. It's as if the market is holding its breath, waiting for a decisive move in either direction. This lack of momentum reflects the push and pull between optimism and caution that defines today's trading environment. Yesterday, all three major indexes closed in the red, signaling that summer's optimism is fading. The losses were broad-based, touching everything from blue-chip stocks to smaller companies, and leaving many to wonder if a new phase of volatility is beginning. Investors are digesting new legal and economic developments, leading to caution. Recent regulatory changes, ongoing trade negotiations, and fresh economic data have all contributed to a sense of unease. Many are reevaluating their strategies, weighing the risks and rewards of staying invested. The Cboe Volatility Index, the market's fear gauge, ticked higher, showing rising anxiety. When the VIX climbs, it's a sign that traders are bracing for bigger swings in the days ahead, and that uncertainty is on the rise. When the VIX rises, investors are paying more for protection against declines. This often means buying put options or other hedges, just in case the market takes a sudden turn for the worse. It's a defensive move, reflecting a desire to safeguard portfolios from unexpected shocks. This is like buying insurance for your portfolio. Just as you might insure your home or car against disaster, investors use these tools to shield their investments from potential losses, even if it means sacrificing some gains. The combination of a higher VIX and mixed futures paints a picture of a market on edge. It's a landscape marked by caution, where every piece of news is scrutinized and every forecast debated. Everyone is waiting for a clear signal about where the economy is headed. Until then, the market's uneasy pulse will continue, with investors watching, waiting, and hoping for clarity in the days to come. A major court ruling has thrown U.S. trade policy into chaos. A U.S. appeals court declared most Trump-era import tariffs illegal, leaving businesses uncertain about the future. The government plans to appeal to the Supreme Court, so the outcome could take years. This legal limbo makes it hard for companies to plan, and investors hate unpredictability. Tariffs have shaped supply chains for years. Now companies may face another disruptive shift. The uncertainty is causing Wall Street's cautious tone. Multinational corporations, key components of the Dow and S&P 500, are especially affected. Until the Supreme Court rules, this issue will fuel market volatility. Boardrooms and trading floors are abuzz with speculation. The market is holding its breath for clarity. Google's parent company, Alphabet, just scored a significant victory in one of the most closely watched antitrust cases of the decade. For years, regulators and industry watchers speculated that Google might be forced to break up its sprawling empire, potentially spinning off major products like Chrome or Android. But this week, a federal judge delivered a ruling that changed the game. The judge decided that Google would not have to sell off any of its core businesses. This decision sent shockwaves through the tech world and sparked a surge in Alphabet's stock price as investors breathed a collective sigh of relief. The threat of a forced breakup, which had loomed over the company for years, suddenly vanished. For Google's leadership and employees, the ruling means business as usual. No need to dismantle teams or split up products that have become household names. The company can continue to operate as a unified tech giant, at least for now. However, the judge did impose new restrictions. Google can no longer sign exclusive contracts that block rival search engines from gaining access to key platforms. This is meant to level the playing field and give competitors a fairer shot at reaching users. In addition, Google must now share certain technical information with its competitors, making it easier for other search engines to integrate with devices and services where Google has long dominated. These changes are designed to open up the market, but they stop short of a full-scale structural overhaul. The core of Google's business remains intact, and its dominant position in search is largely unchallenged. Interestingly, Google is still allowed to pay Apple to remain the default search engine on Apple devices, though the process will now require more transparency and oversight to ensure fair competition. For Google, this is a major win, a validation of its business model and a clear signal that it can continue to operate as a tech powerhouse. For government regulators, however, it's a setback in their broader effort to reshape the technology landscape and rein in the power of Silicon Valley's biggest players. In the end, the fundamentals of the search market remain largely unchanged. Google's grip on the industry is as strong as ever, and the company has, for now, dodged the breakup bullet. The Google ruling ripples across the tech industry. Apple benefits, keeping its lucrative deal with Google intact, boosting its stock. For Microsoft, Amazon, and Meta, the decision suggests courts are reluctant to break up tech giants, favoring behavioral rules instead. Still, new restrictions on Google set a precedent. Other tech firms could face similar limits. Regulators may now target exclusive deals or self-preferencing in other markets. For startups, the ruling offers small openings but leaves Google's dominance intact. The playing field is only slightly more level. The decision signals more oversight, not revolution. Big tech remains powerful, but the rules of the game are shifting. The industry is bracing for more regulatory battles ahead. What does this mean for internet search and users? For years, Google has been the default gateway to the web for billions, shaping how we find information, shop, and even connect with each other. But now, the landscape is shifting. Regulators and courts are pushing for more choice and transparency, aiming to level the playing field for smaller search engines and new entrants. This could have ripple effects across the entire tech industry, influencing not just what we search for, but how we experience the internet itself. For the next 6 years, new devices will offer a choice of search engines during setup, giving rivals a rare shot at reaching users. This is a significant change from the past, when most people simply accepted the default option without a second thought. Now, users will be prompted to consider alternatives, potentially opening the door to new habits and preferences. This could spark more competition and innovation, but Google's brand and product quality remain tough to beat. The company has spent decades refining its algorithms and building trust with users, making it a formidable competitor. Still, the promise of real choice could encourage other companies to invest in better technology and more user-friendly features. Most users may stick with what they know, so change will be gradual. Habits are hard to break, especially when it comes to something as routine as searching the web. But over time, even small shifts in user behavior can add up, slowly reshaping the market. Competitors must offer compelling reasons to switch, like better privacy or unique features. Some users may be drawn to search engines that promise not to track their data, while others might look for specialized results or innovative tools that Google doesn't provide. The ruling opens the door to competition, but Google's dominance will persist. Its vast resources, global reach, and integration with other services give it a powerful edge. Yet the very act of giving users a choice could slowly chip away at that dominance. Expect slow, incremental change, not a revolution. The search engine market is unlikely to be upended overnight, but the seeds of transformation have been planted. Consumers may see more choices and better products over time. As competition heats up, search engines will need to differentiate themselves, leading to new features, improved privacy, and perhaps even entirely new ways to search. The search engine wars are far from over. In fact, they may just be entering a new and more dynamic phase, with fresh players and unexpected innovations on the horizon. A new chapter in online search is beginning, and the choices we make today could shape the digital world for years to come. Wall Street is focused on key economic reports this week. Today's Federal Reserve Beige Book offers real-world insights from across the country, hinting at future policy moves. If the report signals inflation concerns, the Fed may hesitate to cut interest rates, affecting markets. The rest of the week centers on the labor market, with job openings, payrolls, and unemployment data leading up to Friday's crucial August jobs report. This report shapes market confidence and impacts everyone's financial life. Strong job numbers boost spending and the economy, but can also fuel inflation. The Fed faces a tricky balancing act. These numbers matter for your job security, wages, and borrowing costs. Everyone is watching closely. Nervous investors are flocking to gold, which hit a record high above $3,500 an ounce. Gold's surge signals a flight to safety amid trade policy uncertainty and global economic worries. Concerns about government debt and currency value are also driving demand. Gold's price reflects global anxiety. Meanwhile, copper prices are rising, topping $10,000 a ton, signaling optimism about economic growth, especially from China. Copper is used in construction and manufacturing, so its price often predicts economic health. Rising copper suggests factories are busy and demand is strong. Gold tells a story of fear. Copper whispers hope. The market is torn between caution and optimism. These commodities capture the market's divided mood. Several companies are making headlines. Salesforce reports earnings today, with investors watching AI demand as a tech sector indicator. Kraft Heinz shares plunged after announcing a split into two companies, raising concerns about disruption. In contrast, PepsiCo's stock rose after activist investor Elliott Management took a $4 billion stake, signaling possible changes ahead. These stories show how company news can move stocks, even in uncertain markets. Upcoming earnings from Dollar Tree, Hewlett-Packard, and Campbell's Soup will offer more clues about consumer and business trends. Each report helps shape the market's direction. What's the bottom line for you? Uncertainty rules the markets, with mixed signals from stocks, trade policy, and commodities. For investors, this is a time for caution and diversification, not panic. The Google ruling reinforces big tech's dominance, but offers small opportunities for competitors and consumers. Regulatory risks remain, but courts are hesitant to break up tech giants. Economic data, especially jobs reports, will directly impact your finances and borrowing costs. Stay informed, but don't overreact to daily headlines. Company news like Kraft Heinz and PepsiCo shows fortunes can change quickly. Focus on long-term goals and a resilient portfolio to weather uncertainty.